Parrott, your host. All right, I'm going to try to share some things with you today. The goal here is I want you to understand what's going on in the world economy and, of course, here in the U.S. and what that means to you as far as your future. When you look at what's going on in the stock market and the tremendous amount of volatility that we've seen in general, and economists are saying this is a period where we're seeing more frequency of financial crises, more frequency with regards to volatility, and it's basically just a riskier time in which we live. Now here's where the downside, when we talk about, again, interest rates, a recent article about interest rates staying lower for longer. And there are two schools of thought on this. One being that that maybe in a regular cyclical growth, we're going to see, improvement with regard to the economy, with jobs, with wages. But how's that going to happen? Not under the current regulatory environment, certainly is not going to happen. Not under, when you see all the debt that's out there that's weighing down on things, that's certainly not going to help. And having to deleverage, in other words, pay off that debt is one of those things. How are we going to do that? How do governments, all right, for instance, how are they going to deleverage? They have to increase revenue, tax revenue. How do corporations, if they have debt, how do they do it? Same thing, they've got to increase revenue. They're not increasing revenue. We're not seeing revenues increase in corporations, which is why we have this bubble, if you will, this overprice, this overvaluation in the stock market. What does that mean? That means we're primed for a bear market. Now, is it going to happen in the next few months, few years? Who knows, okay? All I know is that we're primed for it, and many experts are saying this. When you're looking at what's going on in the market, and you listen to someone like John Bogle, the founder of Vanguard Funds, and the expectation that we'll have two bear markets of 20 to 50% over the next 8 to 10 years. And that's too hard to believe. Since 2000, we've had two such bear markets. One in the 2003 cycle of over 44%. And from October of 07 through March of 09, over 50% drop in the market. So we're due, and particularly due right now. So the expectation is sooner rather than later. But what do? If you're not in the stock market, where do you put your money then? Do you look at safe things like I talk about in my book, right? Chapter 4 about safe money options. Well, what's the problem there? Low interest rates. So if you're looking at things like money markets or CDs or savings bonds or treasuries, even short-term fixed annuities, all of these are paying less than what it would take to stay ahead of inflation and taxes. So even though you're getting the guarantees and safety, unfortunately, you're not getting the returns necessary. And then when we think, well, what do we look to then? We look at the stock market. But what did I just show you with the forecast, right? According to, and this isn't just BlackRock. They happen to be one of the biggest, so it's one there. But again, John Bogle, same thing, about a 4% growth over the next, as far as equities expectations. So, and that's if he was 100% equities. In other words, that he's talking about a 4% growth rate. Now here's another one, McKinsey Institute. And by the way, Dr. Robert Shiller, he won the Nobel Prize in 2013, also talking about equity returns when you look at the Shiller Cape Index. And again, these predictors are low single digits with regard to the U.S. stock market. And they're talking 4%. And that's like if you had 100% in stocks. Not many people invest that aggressively. And keep in mind the amount of volatility, the big swings that you might have, big pluses possibly of, like, if you look at the S&P over the last 16 years, you may see highs in the 30% range as far as in 1 year, but you also saw lows that were negative 40 to 50% over that same period. So that's a tremendous amount of volatility to have to deal with to end up with a 3 to 4% return. Right, so let's look at, and this is another McKinsey Institute, another research group, and what they went a step further. They're not talking about just U.S. equities, which are around that 4% range. European equities in the same range. U.S. government bonds. Okay, when they're looking at bonds, they're talking about around 1.7% on average. If you look at European government bonds, about 1.6%. Now, if you take then, just think about that. If you're going to take a 4% stock portfolio and blend it with a bond portfolio, you're going to end up again around that 3% mark. It's amazing, but many, many different sources all coming up with the same results. Right? We might want to consider that as to what it means in terms of the next 8 to 10 years with regard to your own planning. Okay, there was we talked about the 4% rule, that you could take 4% out, and how long that, most all economists now said, nope, that's not going to work. And when we're looking at these kinds of rates of return, we may be talking 1 or 2%. How are we going to get over that? So let's take a look at a couple of things here that might be helpful as far as perspective. One, we talked about low interest rates in the Wall Street Journal. It was reported as well. Fed's low interest rate cracking retirees' nest eggs. Pensions. This is one of the things that used to be a stand, this was what we counted on, right? We would have Social Security and we would have a pension. And look at this, in the early 1980s, 60% of employees had pensions. Look at that, today it's down to 18%. That 2011 number hasn't changed much. It's still right around 18% today as it was when this study was done at that point. All right, the next thing, married people are living longer. So now we're not going to have as much income because we're not going to have, for most of us, right, 4 out of 5 people, 80% of the people out there are not going to have a pension, just Social Security, and the rest of it's going to be based on either savings or investments, right? Well, savings and investments, and possibly working and working past the normal retirement age. Male life expectancy, and by the way, as you can see from this, married people live longer. So if you're single out there, go get married. No, that may not be enough of a reason. Anyway, male life expectancy for a married couple, age 85. Female life expectancy, age 88. So for you married people out there, this is one of the things. Think in terms of that money not lasting just, and it's got to last for 2 lifetimes, right? Women living longer, married life expectancy, age 92. So that's that, it's like 25%, I think, is the number expected of married couples. 25% will reach the age of 90 plus. So you got to have more money. Now here's the next thing. The success of your retirement is really not about your assets. Okay, and let's take a look at this next slide, for instance. Assets can be lost, right? Stolen, swindled, sued, divorced, or decimated in a market crash. How many people I have seen over the years who just before retirement went through a bad market period, or their investments were just, they were poorly invested, and they lost a big amount of their money, and it put them to where they couldn't retire. They had to continue to work or go back to work or reduce their lifestyle. So what is the success of your retirement? It was more likely, it's going to depend on how much guaranteed lifetime income do you have, all right? Have you taken the key retirement risk off the table? So here's another way to look at it. Market risk, early losses in retirement. And none of us know this, right? I just said we're primed for a bear market. We're overdue, in fact, for a bear market, and with the monetary policy, all the things I've been talking about, it's a wonder that the expectation is over the next year, 2, 3, we should see a pretty substantial bear market. And what happens if you're retiring into a bear market? That red line shows what happens. The likelihood of running out of money goes way up. Okay, your money could only last 15 or 16 years. Now, when life expectancy in retirement is 20, 25, 30 years, okay, running out 16 years in is not something we're going to be real happy about. Whereas if we are as you can see with that top blue line, if you're going into if you've got a more stable income, if you're not having to worry about that income coming out of your retirement, and the market treats you, better if you've got a way to invest to do that, and I'll show you that, then your money would last 30 plus years, and that's what we're looking at. Now, before we talk about inflation, there's something that I want to share with you. All right, so we're going to get rid of the slides from it. One of the things in Tony Robbins' book, and this, again, goes to the sequence of return of running out of money, and it talks about, he uses a great example of 2 investors that invest in the market in the same way, all right? Now, I may have shared this before. This is in Tony Robbins' book, Money Matters, okay, and this little chart, it's on page 413, and he talks about John. John he had $500,000. Now, imagine this. You have $500,000 saved up for retirement. You're going to you're saying, I need $25,000 a year, 5%, to live on, to maintain my standard of living and quality of life. I need that to stay up with inflation, because what's going to happen with inflation is it's going to reduce those purchasing powers, and I'm going to come back to that in a moment. So my $25,000, and let's say we're going to increase that by 3% for inflation over time. So what happens by the time John's 83 years old, he's broke. His $500,000, now he averaged, by the way, 8% a year on his money. Imagine that today. If you could average 8% a year, you'd be pretty thrilled, wouldn't you? So even averaging 8%, when he started out at just taking 5% and then increasing it with inflation, he still ran out of money in about 18 years. Now here's the other part. He had, on taking his income, he only ended up with a total withdrawal on that $500,000 of $580,000. Why? Because the market went down the first 3 years he was in retirement, much like it did in 2000 through 2002. And so that created a situation, because of those market losses and his continuing to take income, that he could never really fully recover from that market downturn. Now let's take another investor. Let's talk about Susan. Susan also had $500,000 saved for retirement, also earned 8% a year, but the difference was when she retired, the market had a strong 2 to 3 year period, and then the negative period didn't end or didn't come in until later, 20 years later into her retirement. So what happened? In Susan's case, same $500,000, earning 8%, but because she didn't have early losses, she ended up taking a total of $900,000 out over her lifetime to age 90, and still had $1.6 million left in her portfolio. $2.5 million versus $580,000. Both started with $500,000, both earning 8% a year, but the sequence of return, when you start taking money out, that's where it can trap you, okay? That's what can cause you to run out of money. This is one of the risks when it comes to retirement. When we come back, I'm going to talk a little bit about inflation, how it works in, and I'm also going to share with you some strategies to show you how you can, in fact, protect yourself. If the market goes up, you can make money. If the market goes down, you can still be protected and you can make money. All right, if you'd like to know how to do that, stay with me. We'll be right back on the Retirement Report.